one gives a shit about a company that does 200 million in top line and grows with 30% margins, right? No one cares. It's like, you want to bet on AI? Bet on Facebook, bet on Amazon, bet on Microsoft. It's so obvious.
Team, I am so excited for this. I've been really looking forward to this one. I'm so used to having a one-on-one. Now I get three brilliant brains joining my terrible British accent. And I'm just going to dive straight in. We're doing State of the Seed Market today. Sam, I'm quoting you. Seed investors need to come to terms with the fact that this is not an 18-month timeout. It's likely much longer, and even the death of systematic thematic seed funds. Can you help me understand, Sam? What did you mean by this?
I think I said it. No, I mean, like, look, look, I've seen a lot of eras of seed investing in my life and career so far. Actually, hilarious. I was just reminded of this by someone. You know, my father, as he used to say, was an incredibly active seed investor in the late 90s in the East Coast. He used to call himself, he used to say, I'm the largest seed investor in the East Coast, which is kind of like being the smartest utilities executive, right? And so I used to sit in a ton of meetings when I was a kid in the late 90s and kind of watch the rise in the 2001 crash. Did a bunch of angel investing myself through the next decade, ended up starting a seed fund with some friends, in the last decade. So I've seen a few eras of this. And I think what was unique about the last era of seed funds, which really was the first time it got big and institutional, right? Was this era where really the role of a seed fund was to kind of be the first step in a factory production line of startups that you popped out the back end, $1 to $10 billion valuation companies pretty predictably, right? And, it was a factory system. You found a company, you packaged it up, you knew what the Series A firms were looking for, you knew the Series A firms, you say, okay, we're going to hit these two metrics, we're going to pass you to the next line of production. Next line of production does their things, passes them to the Bs, pass them to the Cs, eventually pass them to Goldman Sachs, pop them out, $10 billion company, everyone makes money. That's over, right? Because I think that was predicated, it wasn't just zero interest rate policy, there was a bunch of things that was predicated on, but it was predicated on this idea that because of technology and things like AWS and platforms, that you could very predictably manufacture good companies, right? Not great companies. You weren't trying to manufacture a Facebook. Every once in a while you get lucky, right? But you could manufacture predictably the DTC companies, the companies on theme. You knew what people wanted. You passed it through the line. That's over, right? Because it turned out that didn't work, right? Like everyone got excited about these companies and all these companies got crushed once they went public, right? They're not good companies. The market doesn't want, and we were in plenty of them, right? Along with everyone else. My view when I say seed is dead is that I think the factory model of seed, which supported massive scaling of it, is dead. And we're kind of back to where we have been historically, which is seed is a bespoke industry. It's a bespoke thing. Some people can do it well. It's about being better at pattern recognition. There's certain things you can get right about it. And it will be a power law game where you'll still have a few huge victories and a lot of losses. But, the idea that you can sit there and just manufacture pretty good outcomes from seed, I think is over and not coming back.
Jason, Frank, who wants to take the baton here?
Well, I'll take a baton, but let me ask Frank a question to do it. I know that you've posted so many interesting tweet storms on how things are challenging and what's going on in venture now. And all of us actually are ex-founders and have been doing this a little while. Is this really worse than like 2018, 2019, 2017? I only do SaaS and cloud, so I've not done any trendy investments. I completely hear Sam's point, but to me, it doesn't feel, there are elements that are harder, like these crazy valuations, the $700 million caps on pre-seeds. That's new. But the core investments, the core deals, I just feel like we just got to hit a reset button and go back to the vibe before, late 2019. And I think the model kind of works, even if it's bespoke. To Sam's point, even if it's bespoke, I don't know why it's broken today.
So the way I would answer that is I think about the manufacturing process of companies the same way that Sam articulated it. You basically are trying to de-risk companies in stages. So you put money into a company, and at the seed stage, it's the closest thing to trying to get a writing sample out into the world, right? So you have a new author, you have a new story that's never been written. The whole goal is to see what they can accomplish with a little bit of money. And I think what's broken is what's happened from that point forward, right? And I think about it as the 2017 to 2021 era was the era of alphabet soup, right? So you had an A round, a B round, a C round, a D round, an E round, an F round, like extensions. So you weren't de-risking businesses systemically. When capital was incredibly cheap and it was abundant, it almost I wouldn't say forced, but it encouraged, founders to actually invest in multiple S curves at the same time. It encouraged them to have more ambition to try to immediately jump to a great company instead of going through the stages of building a good company first. So I think if we hit the reset button, it's about saying, look, there are 4 stages of de-risking in the business. There's the seed, there's the A, the B, and then C is really private equity and connecting the dots to a profitable company, right? And figuring out what an exit looks like. And if we get back to a much more efficient, way of de-risking businesses, which means that you will have a failure rate. Darwin will do his job along the way. You will have 20 to 30% failure between seed and A. You will have 20 to 30% failure between A and B. And I think that is the rude awakening for a lot of seed investors and Series A and angel investors who haven't seen this environment before, that they think it just, thing go up, valuation go up, company get funded. And I think those days are over where you have to get far enough, fast enough. Otherwise, the money isn't going to be there.
I think these are all good points, but this idea that it's all sequenced, right? And that these are products. When I started investing in venture in 2013, SaaS was much smaller, right? But I knew these VCs that had offered me term sheets, the Byron Dieters from Bessemer and Josh Stein from Threshold and the Excel team. I actually thought my job was to package my investments up. I would invest in a funky outsider company like Pipedrive from Estonia or Algolia from France or TalkDesk from Portugal. No one heard of them. I felt like I had a couple jobs. Help them, bring in a VP of sales, and then package this thing up as a product, like actually more so than today when the world was smaller.
Absolutely.
And I spent 30% of my time, and I'm not a schmoozing with these guys, schmoozing with Byron and Josh. And I would socialize like a plate of things. Here's what I got going. You like search. I got this, you like contact center. I don't think that's a bad thing, even if the denominator is like exploded, is it?
I mean, I just think that's called investment banking, right? Like, and I do think in the end of the day, like, look, we do that as a firm too all the time, right? Like, that's actually a core thing. And I think we're pretty good at it, candidly. And we have a whole strategy around how we think about this stuff. I got to say that, like, when I look at our seed portfolio over a long period of time now, my own personal investing longer, the seed deals that have mattered have always been the ones that were hardest to package. They were not on the factory line. The places we've made serious money have always been the places where we had a thesis at seed that was super weird and it was super cheap because it wasn't a thing that was going to be on the factory line and any firm could package and kind of pass to the Series A people. And then we were right. To your point about mortality rates, we've looked at our portfolios recently and it's comical how low the mortality rates are. That's obviously shifting in real time, right? And will go up. But I just think it's like, I think about my own personal investing and whether we've been successful or not. It's not clear to me in a world where, you look at the failure rate, the overpricing, the lack of real public, things coming out of the back end for all the middling companies. I'm not talking about the every once in a while breakout. I'm talking about like the middling kind of, you can manufacture it, SaaS or whatever, right? If that goes away, then I think the entire staging system really breaks down, right? And I do think we're back to a game where venture capital is what it always was, which is you find something really interesting that's not everyone likes, right? That's kind of off theme and you're right about some very different thesis. And then you make 1,000 times your money. Not, okay, we know what the playbook is and everyone does pretty well. I think that's and I think the problem with that is that if you don't have a manufacturing line, then the LP stories get way tougher, right? Especially at the scale we're talking about, right? You're not going to have a bajillion seed funds in an efficient market for seed, right? Because, everyone loves a capital, a factory, and the story of, well, you should bet on us because we are really good at identifying weird shit. And every once in a while we'll make a ton of money and we're going to also light a bunch of money on fire is a way less palpable LP story, right? Than what we've been running in the last decade.
Yeah, I think, Sam, one of your partners, Will, who I spend a lot of time with, he said, one of the flaws of the past few years is that everyone was trying to earn the right to do the obvious, right? So they were trying to earn the right to win these deals that everybody thought were good deals. And by the time you ended up pricing them, you ended up getting a pretty bad deal, right? It really wasn't a good deal.
Yeah. %100%.
Flaw in the ecosystem is that pricing has slowly started to correct, but it still hasn't corrected at the seed stage.
Yeah. Definitely agree with that. It's a good line from Will. Will has good lines on this stuff. But yeah, I mean, I think that's in the end of the day, like I think seed funds and seed investors, like the model has to be selling very expensive money that when you're right, you're really, really right. And this idea that there was an efficiency to it, the market got big enough and whatever, and everyone was competing for the quote unquote, I totally agree. Like that's the place, that's the breakdown of the factory, right? That's the standardization that goes away.
Guys, can I ask you, you said there about pricing and it's starting to correct a little bit. I'm not seeing that. I'm seeing multi-stages come in harder and harder, not wanting to deploy Series A and B checks. I'm seeing more and more rich tech execs wanting to angel invest. I'm continuing to see more and more people raise funds or start to try and raise funds. Pricing hasn't corrected for me. Am I in a world of my own, or are you seeing something different?
So it is starting to ripple its way back from the public markets to the later stage rounds, and from there to the mid-stage rounds, and starting to ripple earlier. I think what you're seeing are more capital efficient businesses and business plans being built, which I think is a fantastic thing for the industry. So they're asking for slightly less capital because they can't invest in multiple S curves at the same time. And I do think that the correction is occurring. It's just happening slowly because a lot of insider rounds are happening in order to extend companies to earn their way into their valuations while we go through this seam. What I worry about if there isn't a correction at the earliest stages is that, the de-risking of businesses and the building of businesses is a multi-stage game. And just because it's healthy for the first move doesn't mean that it sets you up to make the other moves well. And if pricing doesn't correct at the earliest stage, you're going to have a lot of no bids, at the Series A because they wouldn't have gone far enough, fast enough for a Series A investor to come in and say, they've earned their way into a significant increase in valuation. And what a lot of founders don't realize is that venture capitalists, a lot of them, would prefer to give a no bid than to deliver the bad news that we like your company, but guess what? It probably needs to be a flat round or a down round to the last round because you haven't earned your way in. So you're reducing the aperture of downstream capital if you've overfunded yourself at the wrong valuation early on.
For sure. But do you think founders care or listen? I don't think any founders are listening to these terrific insights on Twitter. And I don't think that they are ratcheting back their valuation expectations. And I think very few are worried that when they do their seed at 30 post, that will impact an A unless they execute to perfection. I can't even convince a founder that's true in 2023. I can't get any of them to believe it.
But I think the answer is, I don't think it's going to happen with the founders. I agree. And the reality is the seed world, the tantalizing prospect of 1,000x return, if you really believe it's there, we'll get a lot of people in. It's like cents on the dollar. Like, who the hell cares? I even do this. There are places like, in history, there have been a few instances my partners are like, we like the deal, it's too expensive. And I'm like, fuck it. I'll put in a few personal dollars because, like, who cares? It's so little money, right? And I do think it's cool and, like, whatever. I do think it's like that is the problem with it, is that, like, it is a market, but it's not fully a market in terms of how people treat it in a lot of ways. And I don't think, but I will say this, like, we'll basically no bid lots of stuff where we don't see the huge asymmetry at this point. Whereas before, when the factory model exists, we'd be like, even I will admit, I'd say there are two types of deals we did. We did deals where like, we have fundamental conviction from zero. Hopefully no one else does, which means the price is super low, right? Because and we love that. It's in some ways you're hunting in the right ponds if the price is low. Like that's the key indication because it means no one else is bidding. Like that's where we made all of our money, right? Or I'll be honest, even we got sucked into, there's a factory model. We know how Sequoia is going to buy this. We know what the markup looks like. We might as well plug into it. We have access. And I think that, at least for us, that latter stage just kind of goes away. And I think a lot of good firms will do that. I think that'll change what types of opportunities people go after. Those things will still exist to a point, but, over time, slowly, these things will correct.
The fundamental flaw in the discipline is that those 1,000x return companies only exist in areas where TAM probably is unlimited or TAM probably is like extraordinarily large. And all of this generic advice going to founders, people are looking at them like they have an unlimited TAM for every single company, because I think this standard dilution concept is like a bunch of crap. Like standard dilution is basically saying that your valuation is just a division exercise, saying that this much money and therefore my company is worth this much. And not every company is pursuing unlimited TAM or in large markets could drive 1,000x. So it's hard.
I totally agree, Frank, but I think the other way to look at it is like, do you need the Series A firms and B firms? You know, like or you say like there are lots of 1000x with smaller TAMs, right? If you're just like, I actually am just starting a business. I need $3 million to get it started. I need it. No one else is going to give it to me. Let's get it going, but we're running it as a real business. You know, my wife started a business that does tons of millions in top line with $0 of outside investment. I just had a friend over this weekend who blows my mind, actually. You know, when I started my first company, we had excess space in Dumbo in like the mid 2000s. By far the most successful company come out of that is a company called Muckrack, right? Unbelievable success, right? And it was the team in the corner that actually took $0 of VC, right? Until very, very late in the game when they did a private equity priced round. That does not need to be an unlimited TAM. That will generate billions, right? And so there are...
The key here is, and I think it's something that needs to be relearned in the venture industry, companies need to learn to make money at low levels of scale, right?
Yes.
Either you're in an unlimited TAM market where you can justify putting capital into the business and continuing to pour capital into the business. I think some SaaS companies, like the TAMs are just gigantic when you look at, you know, the markets that they're actually serving. But there are a lot of other markets where the only way to get a venture return is to be incredibly capital efficient and make money at low levels of scale.
But isn't like this the greatest moment in history for that, given the platforms that exist? I mean, to me, that's the most exciting play. I mean, to me, there's every once in a while you get a let's literally shoot for Mars, fuck it type play, right? Where like, you know, you need more capital, whatever. But like, I actually think the world would be much healthier, to your point about TAM sizes, if a lot of seed funds came around and started focusing on businesses that are great businesses that you can start and scale with revenue, with growth, with quality throughout. And capital raising just becomes an option, not a requirement.
But do you mean as part of that, the exits will be low, like getting your arms around old school exits of just 200 or 300 million? Are you suggesting VCs will have to get comfortable with that? I think that train has left the barn.
Look, I think you can't, like, look, the answer is there are plenty of companies that I've seen in my investing career where like they absolutely should have, and we're in a great position to quickly exit for a few $100 million. And the gap to being public companies was so large, right? That like it was never going to be surmounted. And the reality is like finance properly at seed, that can be a great return if you get really good at it, right? Like that is a thing you can do. You know, I do think though that in the world of like, you know, the world of Stripe, in the world of AWS, in the world of a lot of the things, there's a ton of businesses in the world, right? Which are, let's call it $1 billion businesses, right? That, you know, you can start for a few $1 million and work on for a decade and be in a really interesting place. You know, those can't be public companies, right? And like trying to think about everything as an infinite TAM thing is a disaster. You know, most of the world's businesses are small businesses. They're not, you know, even if you add up Facebook, Amazon, Microsoft, Google, that's a small percentage of the TAM of the world, right? Like, and I think actually, you know, the reality is focusing on the gajillions of businesses and spaces that have been left out for TAM reasons is exactly where to go as a seed investor.
But the operative question is, how much can you learn for how much money, how quickly, right? If I could learn everything about a business for $1 and then know whether it was going to be a $100 million outcome or $1 billion outcome or a failure, like that $1 is incredibly well spent. And the problem is a lot of the businesses during this last super cycle, especially towards the end, you actually didn't get a lot of knowledge about de-risking and a lot of money had been invested in the business. You know, if I look at the history of our 20x pluses and we have a few 100x pluses, like these were businesses that for very limited amounts of money were able to de-risk the business so that you knew that you were on a path to something very big. So I think the sloppiness was inserting a lot of capital into companies before you had cracked the code, right? And that almost de facto ruins returns.
Maybe, but I think the reality, I mean, this is the way I would say we talked about it generically for a long time, which is seed investing is about de-risking the 1 to 2 key bets, which then unlock a Series A. Like there's got to be 1 or 2 theses that you're proving/disproving. And then once you've done that, oh my God, you're in a much better place for your next round and more capital comes in. I actually would argue that like that is what I would say is not going to happen anymore, right? Is like the idea that you're just de-risking and there's an efficient market downstream of you, right? Is the thing that I am no longer willing to consistently bet on, right? I'm much more interested in saying for $2-3 million, start making money, like start something that's profitable, right? And then get me to a place where like every subsequent capital raise is a thing I can do if the money is priced well, if I know what to do with it, et cetera, but I don't have to do. With rare exception, like don't use your seed dollars as an experiment to de-risk anymore. Use them. The experiment / de-risk should be actually having a business that works.
Can I throw out a meta question, Harry? Maybe you could comment too, but to the group. When I'm looking, let me talk to you what I think the ultimate seed investment was. Maybe not even SaaS, but SaaS adjacent is the trade desk. Okay. The trade desk today is worth $40 billion, $41 billion. It was led by two true seed funds, right? IA Ventures, right? Well, I don't know. Tell me, $50 million fund, and Founder Collective, a $20 billion fund. I think IA owned a little bit more, but let's call them both. In a round and a half, they bought 20%, right? So I know they did distribute early, but let's assume they held to 40 billion. They each own 20%. That's 8 billion each out of funds that are smaller than 80 million, right? So this is classic. I'm going to get in at single digit millions. I'm going to own 20% through 2 rounds with 2 great founders. And my bigger concern is that I think those are deadish in seed, right? Owning 1% is still good. 1% of 40 billion is good, but that's the classic seed that I think we're griping about. Like, can we do trade desks today, right? Because that's your career. You know, I mean, Rogers retired. And he had a few others in that fund. I mean, I don't know what that fund was, but it was double-digit X a long time ago, right?
Yeah, I mean,
just a thought. Does that exist? That magical seed deal?
I mean,
right?
I would argue in the last several years, absolutely, but it didn't exist in the factory model, right? Like, I made 1,000X on our Solana seed, right? I have a company called Team Shares, which we put in our first check at 4 posts that is now touching $1 billion and is a real company with hundreds of millions in revenue.
Last rounds in Team Shares.
Thank you.
We love the company.
We're in there. You know, I bought 20% of that company for $500,000, right? Like, those deals exist, but like, the reasons those existed is because people didn't like them then, not because they did like them, right? You know, and so like, I think that's the key. For sure. Yeah.
But if those exist regularly, then seed is the best. It's even though it's unpredictable and it's hard to get information, it's epic. Right, that's where you get your 1,000X of those trade desk like deals, right?
Yeah, I just think you have to be willing to light a lot of money on fire along the way, which I think is, you know, the other part of it. It's like, you know, I'm not saying that you can't, but again, what I would say is, I think maybe we can all agree then that here's the thing. To your point about sizing, the other thing is fund size, right? Like, if you have a 50, even $100 million fund, you can make seed math work. But these mega seed funds, like, and all of a sudden, oh my God, your $2 billion return is only a 3X. Like, that just, the math won't work, right?
Well, Sam, can I just posit something to you? You said about fund size there. Say if you have a $50 million fund size, you've got 40 million investable, you want to do seed today with the average seed being 3 to 4. You can't lead seed rounds with that and have enough diversification. You got $22 million checks there, and 20 at seed assumes that you're a pretty freaking good picker, and that's totally done with no reserves. So like 50 is not nearly enough. I would argue that 100 is not even enough.
I don't know. But on the flip side, I think like you just got to be good at picking. Like, no one said it's easy, right? Like, I think that, you know, you only get so many bullets in the gun, right? And like, that's kind of how it works. And, you know, the reality, Harry, on this is like, you know, I think with anyone is like, if you have institutional investors, maybe you end up with 3 $50 million funds. And like, you don't need all of them to be 100X funds, right? And so like, and you don't know for long enough, you kind of play it out. So I think there's some squishiness to what I'm pointing out, but I'm just saying that like, you know, I think the most depressing thing in the world is not being wrong. It's being right and not making money. You know, being right to the tune of like having these epic outcomes and being like, oh, fuck, that was a 1X returner of the fund, right? Fuck, right? Like, that's the thing that like is kind of the worst case scenario, right? Because those are rare and hard to find.
No, I totally get you there, and that makes sense. Can I ask, do you think we're looking at loss rates in the right way? Like we mentioned there about kind of the challenges of picking in the right levels of diversification. How do you think about loss rates and whether this generation is completely skewed in terms of the mentality around loss rates and graduation rates?
Yeah, I mean, look, I was looking at some data from Crunchbase just to figure out like what percentage of the entire venture world ends up becoming public companies, right? Which is at least a way of drawing a line and saying these are real companies and these are real outcomes, you know, versus the smaller outcomes of a couple $100 million or acqui-hires. And it ends up that if you go back the past 20 years or so, it's a single digit number, right? And in fact, for some vintages, that number is 2%. For some, it's 3%, some it's 4%. But it's not 8% or 10% of companies end up becoming public companies. So what you're really looking about is, call it a 1 in 50 has the potential to actually execute against a plan, be in a space that's big enough to create the type of outcome the industry actually cares about. And again, I'm not disrespecting the smaller exits, or to Sam's point, you could actually get a fantastic return if a company on $3 million could become profitable and you end up selling it for $300 million. Like, that could end up being an amazing return. But in the venture world in general, like, you need an IPO-able event or a mega sale, of the variety of a Honey or a Credit Karma to kind of make things work. And it's just small.
I don't know, but
So
does
you
it have to be the case, Frank? Historically, I think that's been directionally true, and I think everyone got addicted to this idea that you can manufacture $5 billion companies, not maybe 50, but 5, right? And like but I mean, I'm very interested personally, and I think the future is in these companies. There's a lot of companies you can put $3 million into and get to a place where, like, you're pretty sure it's profitable, it's going to be worth 100, 200, and you have an option on something much bigger, right? Like, that's kind of the thing that I think is most interesting these days, right? Is like, options.
But why is that a better use of time than owning 20% of the trade desk? I think you're a very good and aggressive investor. I'm just encouraging the conversation. But why do you care about that seeming downside mitigation? I totally respect the smaller businesses. I mean, Harry and I have both built media businesses. I mean, I've got one doing almost 30 million on the side. Harry's got one doing million. I get that life, all bootstrapped. But why do you want optionality as a VC, right? It doesn't really, covering your losses doesn't help much, does it?
No, I guess the question in my mind is, like, does building a 100, 200, $300 million company really give up the option value of building the 10 or 20 or $50 billion company? I think there's a lot of examples at this point, right, in history of people that build the kind of obvious winner, right, and do a really good job with it, and then graduate it, like Squarespace, you name it, like Anthony's company, like, we can go down the line. And like, I think people got into this mentality, and it was partially because money was free, and partially because of like Uber and Lyft and everything's in Airbnb and blah, 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 right? Of like, the way to play home run derby is to start with the home run derby mentality. And I actually think it's not like baseball. It's not like by getting on first, you don't get a chance to hit a home run, right? Or a grand slam. I actually think in a lot of cases, getting on first is the best way to set yourself up for a 10-year sprint at a home run. Mixing my sports metaphors, but I think you get the point.
I talk to companies about this all the time, and, it comes from my operator background, but I don't think great companies are just manufactured. I think great companies are built on top of good companies. Like, you have to get to good first, and then you can eventually get to great. And when you get to good, you can stand on whatever that mountain is and look around and see what optionality you have and say, wait a minute, this is a great team. We can expand. We have great customers. Here's what we can do. Or you might find that, you have kind of exhausted the opportunity and it's actually time to sell. So I do believe that great companies are built on top of good companies. But if you're still trying to get a good outcome, for those good outcomes instead of great outcomes, you have to be incredibly capital efficient to get to that good state, right? So if you think about, like, let's make up a number, 10 times enterprise value to paid in capital ratio, right? If you have a 10 times enterprise value to paid in capital ratio, the management team will probably own 30% or 40% of the company at that point, which means that investors are probably getting a 6x return on all of their capital, which means that the early investors are probably getting double that, and the later stage investors are probably getting half of that. Right? So a late stage investor will get 3x, and early stage investor will get 12x. But in order to do that with a $300 million outcome, it means you have to have invested less than $30 million of capital to get to that point. And I think this is what needs to be relearned. The capital efficiency to actually de-risk a business and prove that you actually have a real business. And if we get back into that world, I think it's going to be incredibly healthy for, the ecosystem. Like, every dollar becomes precious. You're generating enterprise value or learnings with every dollar you put to work. And I think
do you think founders care anymore, Frank? I don't think they care. I don't think. Let me give you an example. Harry and I were chatting. We chatted the other day about companies that have infinite runway and are overfunded, okay, and are never going to get anywhere. I only have one in my portfolio. The first time in 10 years. Now, listen, I don't invest as often as you guys done. I've done 25 investments over 10 years, but I've invested 9 figures of capital, and I asked one founder in 10 years for my money back. Not all of it, just some. I just said some. And you know what his response was? And I feel like this is very au courant. What do you care? His response back wasn't why, or I need it, or I want to keep going. It's like, there's no respect for capital. And I'm not saying most founders are that blunt, but I see it again and again. What's yours, Harry?
I got fuck you. So, I mean,
fuck you. That's different.
Yeah.
But I don't think founders care about whether the 10x rule that I wrote, same thing I wrote it 10 years ago, the 10x rule, right? You got to sell for at least 10x what you raised for people to be happy. I don't think anyone cares.
Hilariously and shockingly, there's a lot of nominally or even some known public companies that are tech exits that are not even close to that, right? Like, and it's kind of comical. What a waste of capital, right?
This farmification has changed the mentality of founders forever. Whether we're going back to farms or not, I don't think founders think the same way they used to. I don't think there's respect for capital.
Here's the thing. I think these things change over time, right? You might be right that there's a moment in Silicon Valley, whatever, of founders like that. But again, I just look at my friends who have started businesses they wholly own or put a tiny amount of capital into and have scaled ridiculously. They're happier. They're way richer, right? And they have a ton of option value into the future versus the people who own 10% of hot things, right? And are kind of like holding on to big corporate structures. So I think that there's a big opportunity. And I think what we'll see is, yeah, sure, people will still hear the lure of certain types of venture and go want to raise at high prices and they won't care and they'll do their art project. I actually am very optimistic that there's going to be a whole generation of people who are like, oh shit, I would, it is a much better life to own 80% of a business that has 50 million top line than own 10% of a business that does 500, right? With a bunch of VCs in it, right? And I think you're going to start seeing people being much smarter about how they want to manage their time and their entrepreneurial efforts towards outcomes that are fucking much better for them and candidly better for venture capitalists, right? So yeah, of course, like the kids coming out of Stanford who like have this like, I want to be Elon Musk thing. Like, I'm not going to fund those people, right? Like, every once in a while I'll miss one because like I love the founders fund guys. They're really good at funding exactly the right crazy, right? Like, I'm not going to fund those people in general, but like, I think to me, like, I think it's like too general to say it's a founder thing. I actually think there's just tons of entrepreneurial talent that's going to reevaluate whether they want to be, even the success scenario, running a $1 billion penny stock public company if they win, right, with too much capital in it. I think the answer is everyone's like, that's actually a pretty shitty job.
Yeah. And Frank, I want to inherit your thoughts more, but I'll just throw out one thing. I only do SaaS. I only do classic recurring revenue, boring business software. The fallacy in that point, and I agree with this, I've done it. Like this idea of this, everyone that's killed themselves for an outcome and only owned a little bit and seen the economics and said, oh my God, I want to own my own $30 million business I own 100% of. The fallacy in that argument I've seen in SaaS is maybe I can't say most because there's not enough data. I think they fall behind competitively. I think that venture is not magical. I think venture has been abused the last few years, right? It has been abused to fund overhiring and massive teams that are not required. But you go through a phase transition as you scale. Maybe it's not even until after 5 or 10 million, where if you don't have capital, you can't all be Atlassian or Qualtrics, and they fall behind competitively. And I think that's the trap of the fallacy of the lifestyle-esque business, right? Where media businesses are different. The information can be can be more compelling today than before. But I don't know about a $20 million tip, a payroll company that raised nothing when Rippling and Gusto and everyone is out there, maybe, and Deal, maybe. But I find we could trick founders into a path that doesn't exist.
Here's
right?
my question. This goes from Roberto, which is like, this is not meant to be aggressive, but maybe a little bit provocative, which is like, is SaaS a good place to be investing anymore?
It might not be. I just didn't know anything else. In my initial investment memos, I wrote these were all terrible investments. I remember my first Decacorn TalkDesk. I wrote in the investment memo, this will never be worth more than 150 million. And that is unlikely because 5.9, which was the comp, was only worth 150 million at the time. It might be maybe only B2C and fintech makes sense because that's your only way to have a $500 billion company, right?
Well, or there's like there's a big world out there and there's a bajillion other industries that are great if you take the kind of approach of systematic building and profitability and option value, right? I just think SaaS is a particularly weird race, like for a whole bunch of reasons. And again, like we've done some good SaaS investing. I'm proud of our SaaS investing. You know way more about it than I do and have had more success than I do. But I'm like, I'm not spending a lot of time on SaaS these days. I think partially for the dynamics you're talking about, right? Which is like, I like Parker. And like, I'm super psyched for him that he's like pulled off what he's pulled off. But like, that's not a game that I feel particularly excited about playing repeatedly.
Yeah. I would think about it a little bit differently, which is every time you're putting money to work, you either are getting proof or anti-proof of your thesis and the business plan and the model, that's put in front of you. When you get proof, it means that you're on track to build this magical business that the spreadsheet they gave you describes 3 or 4 years out. Right. Things are coming in line with your expectations. Your go-to-market motion is working. Every day you come in is a better day than the last day. Like you feel momentum in these businesses. And when there is momentum, which by the way is real, momentum is not a fictitious thing. Like for a startup, like when things are going right, they continue to go right. And usually that compounds over time. So if you're generating proof, that's a good time to examine whether capital actually would be an accelerant to the business, or the business even deserves putting the money in. Now, the problem is when you generate anti-proof, right? The go-to-market motion is harder than you projected. Things are getting worse than you thought. The trends are in the opposite direction. Sometimes the wrong answer is to put more capital into that business, right? And the problem with the past couple of years, especially at peak madness, was that, people just looked at the top line and everything was a multiple of ARR. And they said, if you're bigger, therefore you're more valuable, therefore I can put more money into the company. But if it was harder to get that doubling than you thought, or it cost you more to get that doubling than you thought, or your manufacturing costs went up, or the margins weren't there, in that doubling, you're actually generating anti-proof of the business. But when money was free, if revenue was 2x, enterprise value was 2x, therefore I can put more money in the company and feel good about it. So I think we have to get back to actually examining these businesses for what they are, getting rid of the proximity bias of the founders, figuring out how you can be a bit more agnostic as an investor and really look at the business and see if it deserves capital or not. And I think those are going to be like the best investments when you're getting proof without anti-proof. You're putting money into the companies that, are growing and things are actually working and the model is coming true. And I think Darwin will do its job, by limiting capital availability, that I think people are going to start staring at these marginal businesses and we'll see what happens to them.
Guys, can I ask you, we've looked at different models here. We've seen multi-stage funds, as we've discussed pure play seed funds. Sam, you said something that was different to what Jason said the other day, and so I'm intrigued to hear these opposing thoughts. You've written that clubby seed investing and the YC playbook will certainly not work anymore. And then, Jason, we chatted the other day about actually why party rounds and a proliferation of very rich tech execs from the liquid years we've had over the last years is more than ever. Are these two ideas arguing with each other? Are they the same? I'm trying to understand, do we have more party rounds, less party rounds, more rich execs, less rich execs? Which one is it?
I mean, my basic point, I believe, is I think that the YC thing in particular was, if there's a factory if we're talking about venture capital as a factory, that was like ground zero for the construction of the factory. It literally was like, venture capital and like how you raise money and form these companies is like this opaque playbook. It's hard to figure out, And they're like, literally, here is playbook. And then here is demo day. We bring in a bunch of every investor. They bid it up. They justify our 7%. We're done. It's packaged. It moves on the factory line, right? It is the purest part of the factory you could imagine, right? And, as an investor, we've stayed away from it for a long time, partially because there's no signal in it, because everything comes off the factory line looking exactly the same, packaged properly. All looks fine, right? But it's packaged the same, et cetera, et cetera. So to me, that the factory part is the dead part. Party rounds, rich tech execs, sure, there are lots of rich tech execs. And like, again, seed investing is fun, right? Like, and you get 50% of your money back when it fails, right? So the nice part about mortality rate being higher is you get your money back faster at 50 cents on the dollar, right? Like, as a tax write-off. So like, sure, that'll happen. People can team up on that. But I think that's more about the capital side than, in my mind, than it is the factory part.
Jason, Frank, do you agree in terms of YC's days being challenged as ground zero for kind of factory line formation?
Look, I mean, YC has a track record. It has a brand. It has a lot that I would say is a feeder to a lot of funds. In fact, they rely on YC, for their deal flow, or at least a portion of their deal flow. And we find that some of the things coming off the factory, the hygiene about how they were built and what they learned during their period in the factory wasn't necessarily the things or the order that they should be learning. They weren't set up in necessarily the right way. A lot of the growth trajectory was an unscalable things in order to get the up and to the right 45-degree chart so that you can package it for demo day. So there are a lot of artificial things done in order to package it. Like, to Sam's point, it will come off the factory all looking the same. And a lot of that advice you actually have to undo, if you end up funding the company. So you end up overpaying and then having to undo a bunch of the damage, that was done by setting up the company in the first place and the way that they got their early results. So I just worry about, are the companies actually getting the proper advice for the industry they're in? From a generic factory doing hundreds of businesses a year.
Jason, how do you feel?
I am grateful for YC for a couple reasons, but one thing is I like to only invest in outsiders and first-time CEOs on a 2x2, outsider first-time CEO. Over time, the obvious lesson I've learned is you want to find really great CEOs, right? And, sometimes you'll get an email from Frank or Sam and say, hey, this is the best kid I've worked with in 72 years. Like, okay, if you trust them, or Harry says the smartest kid. If it's outsiders and first-time CEOs, you can only guess if you can know as a founder, you can know if they're a better founder than you. I enjoy the fact that YC is an IQ and drive filter. It is not perfect. There are folks in each batch of 200 that are not as smart as the rest or that are gaming the system. Above average, I know high drive and high IQ. I love it. And so I will enjoy that meeting. I will take that meeting. I will take a cold inbound that is worse than a traditional from a YC company. And I don't actually mind the 20 million post. It's okay for my fund size, which isn't even huge. What is hard in today is that the rounds are too split up, right? And I've done 2 YC companies. One, I led the seed Algolia. Hopefully it will IPO next year. And another one I love that we did together, Harry, RevenueCat. But I don't think I could get those ownerships today with the fund style I have. That's for me. I kind of have to give up on YC, not because I won't pay or don't love the signal. If there's 84 people in the round, there's no point in me putting 100 grand in at 20 posts. It just doesn't, it doesn't get me the 100x fund Sam was talking to. It doesn't even get me close to 1x. So I just don't have the time to invest in. I just don't have the time at this point in life. Right. But I love the signal actually.
It's a really important point. I mean, in venture, there are a lot of ways to make money, but you have to choose one of them and do it well. And some of these accelerators is very hard, right? They're crowded. And we don't like crowded cap tables in general. We like when we have, friendlies who have diversity of Rolodex or diversity of ability to hire or diversity of introduction they can make to different companies. But you've got to be very careful about who you're assembling around the cap table. And a lot of these party rounds are like 40 and 50 people, taking up a lot of room. And ultimately, it's kind of a rule of thumb that I have. I like to see as much money on the cap table in the hands of active investors as possible. And when a lot of the money is in the hands of passive investors, it's very hard.
Do Series A investors give a shit if the seed company that's graduating has a party round before or an institutional seed? Do they care?
No. Why would they care?
Yeah, this is the trade-off, the paradox, right? Seed investors might not like 48 people out in the round, but if the seed guys the A guys will still do the deal. Maybe the founders are happy with John Collision and Olivier from Datadog and, all the other folks on their cap table that will respond to an email. Like they will respond. Those 50 guys they won't take a 10-hour meeting, but they do respond to emails in my ecosystem. It's pretty amazing what one that a 10 or $100 billion company CEO will actually respond thoughtfully. More than many VCs, frankly, who's just say, good job. Good job, kid. Good job, pal.
That's my favorite email. Good job. What's wrong with good job?
Let's not say, let me know how I can help. Let's just simplify it to good job.
Sometimes you just go the thumbs up.
The best use of an emoticon ever is the investor update, thumbs up.
If you have 30, 100K checks from amazing individuals and it actually means something to them, it can be just as strategic.
Look, in the end of the day, there are plenty of people who do the seed. They don't need help. They're going to do the seed on their own, right? And sure, a phone call here or there is helpful. And those people it doesn't matter. It's just money. We're just selling the money, right? And it's funny. It's we have this thing, which is very different, I think, probably than it sounds like Jason and Frank, how you approach, which is when people sometimes ask slow ventures, they're or at least I want to speak for my partners, so I sometimes play a slightly different tune on this than they do. But the way I would say it is people ask me, they say well, what do you guys do to support founders? And my answer is always nothing. Now, that's not actually true. There's a bunch of stuff we do to support founders, but like when people ask, my answer is nothing, right? Because if you're coming to me for help, my view is you're almost by definition, or you're saying I need help, all this stuff, or I want help. I think you're a weak founder, right? And like I want founders who are like, I got this, I got the plan, you're money to me, right? And then sure, we will be helpful, and there are things we do, but like I think there's a signal on kind of how people think about that. And it's very different. Like if you are really like, I got this, stay the fuck out of my business. You want 30 famous people at a high price, go nuts. Like it doesn't matter to the Series A firms.
Sam, I'm with you totally, but Jason disagrees with me.
Yeah. I mean, there are many companies, many strategies here, and there are founders in certain sectors where they have everything that they need. You know, we happen to be a specialist firm in a specialist sector where, again, if a founder needs too much help, that's signal. Like if they're relying on us to actually get things done, that is huge signal and a big red flag. But when you have a very talented founder who actually understands the space, and then you add like, again, Rolodex being able to see around corners, being able to actually help, you know, as an example, like, you know, I was the chief credit officer of Capital One, you know, back in a day. If a company needs help writing credit policy or, you know, working through credit issues that they have, like we're actually there to help them. If they need to raise debt funds, like we know how debt funds think, help them do those things. So it's important to understand that not all companies are the same, and even talented founders can use the help if there are other talented people around them. I mean, we almost become employees of the company in the early days to help them accelerate their path.
Yeah. I think to your point, I think that's the right line frame, which is just a lot of different approaches to seed, and that's good. Like, you know, our approach is always going to be, I'd say even mine, even with my partners, is going to be find the weird shit no one else can fund where the money's expensive because the founder has a ton of conviction and wants to go for it, and you can see it, right? And you're going to be wrong a bunch, but every once in a while you're really right? Like that's kind of like, and it's a very different strategy than the like, you know, we have a space we play in and like we, know how to run the risk models, right?
I know almost no founders that are born amazing recruiters. It doesn't mean they're not tenacious. It doesn't mean they won't LinkedIn 1,000 people and set up 1 million calls. I don't know too many first-time founders that know how to recruit a perfect VP of sales or a perfect VP of marketing, let alone a true VP of engineering, even for a CTO. And I think that is an area you can add massive value. In fact, I think that like all venture firms have failed with their talent arms. I think all venture firms that are seed into A should, in theory, actually, they're just investing firms. But if they really want to do what they pretend they should do, at least half the headcount should be recruiting. Not fake recruiting, not someone that doesn't want to work hard at a tech company and is phoning it in at a big venture firm. I'm saying half the time should be bringing that. That's the value or not that VCs aren't delivering. Like none of these talent arms really work, right? They don't. That's amazing. That's what I've seen make the difference.
Look, I agree with you in theory. I guess in practice, like I also would say that like, this is a classic thing of like when people come to me and they're like, I need help recruiting. I'm like, go work with someone else. Right. Like it's like,
I don't think they say that. I think they say what a founder will typically say is, I mean, I've had this conversation 1 million times. I need a great VP of sales. Like they all come to the same conclusion, somewhere approaching 1 million in revenue, right? And they'll go out and find their own person. They'll go hire someone from Okta or Salesforce or Twilio who will spend all of the money Frank just gave them. It'll all be gone in 12 months. But if you can actually help them find that person that was actually the number one person at Rippling today that was there early, that match or whatever it is, it's a game changer, right? I think that, and I think seed firms all think they want to be on speed dial. That's nice, but
I agree with you. And I think sales is a particularly interesting one. I would actually argue in my life as an entrepreneur, I've like never successfully hired sales. I think sales is incredibly hard to hire at startups, specifically because the whole nature of sales is like the people who want to go early are like anti-correlated with the good people, right? Because that is not how sales works, right? Like in general, like the whole point, sales is coin operated. You want to go to a place with the playbook super clear. You just go fucking make bank. The people who are like, oh, I want an entrepreneurial adventure and go early. Like those people are almost always the worst salespeople, right? So I think if you're a specialist at that and you can crush early stage sales, that's a superpower. You don't even need to have a venture fund. You can just take equity, right? Don't put money in. Just take equity for finding that vanishingly small number of people that fit the I'm actually good at sales, not doing it, not just strategizing about it, and I want to go early. I mean, that alone is like a winning strategy. It's certainly not one we have.
Guys, I do want to just be cognizant of time, and I want to finish on a bet. Okay, me and Jason had a bet And we had a bet on IPO timing. And I think he's batshit crazy, but also I hope he's right. So Jason bet me that he thought there would be an IPO a week, I think it was, from the back half of next year. So 2024 H2, we're going to have an IPO a week. The floodgates are going to open on IPOs second half of next year. Do you agree? And would you take the...
Can I understand the concept? Is your thesis on that because everyone will be completely out of money and so they're going to dump it because they just have to get out?
I think times are materially better than 12 months ago, right? Ignore the measurement point of 2021. Public markets are up 30%. Every public company is more efficient, okay? And I have 5 investments I've made north of 200 million in revenue, growing 30% or faster that are now efficient. They're ready to IPO when the markets say it's okay. And they're not going to IPO. They certainly were laughing 6 months ago. But if multiples stay here or go up, they're all going to go out in late 2024, right? It's 2023 is too soon.
The markets are not actually up. It's the biggest players in the market that are up, right? I think that's like the big question.
I might be wrong. Listen, I bet Terry 5-1. I may lose this bet. I just feel like what we're missing in all the ups, the drama, the craziness of the last 4 years. I mean, insane what we went through, right? Is how many good companies got to 200 million or more that are now, bless their soul, that are now efficient. And I may have the timing all wrong. I'm too optimistic, but I think there's 26 of them, which is one a week. I think there's 26 good companies at 200 that can IPO in 26 weeks in the back half of 20, but I may be wrong.
I'll take the under with Harry on this, and here's what I basically say.
Okay, but I'm only going 1-1 on you, Sam. I won 5-1 on Harry. If Frank and Sam take it, I'm just 1-1 because I'm already 50 grand into this, so I'm not going 150 grand.
I'll go 1-1. Here's the basic theory. I think the thing that everyone's missing, and this is I could be very wrong with this, is no one gives a shit about a company that does 200 million in top line and grows with 30% margins, right? No one cares. It's like easier to just invest in Facebook, right? I'm being provocative. Hear me out, which is like, I think this is like actually the big shift in the world, which is like, take the AI theme. It's like, you want to bet on AI, bet on Facebook, bet on Amazon, bet on Google, bet on Microsoft. It's so obvious, like where to put public market dollars. Betting on like a $200 million top line company that's fine, but has a bunch of risks and they're in a market and they're kind of small. Like, it's just, I don't actually think that's the future. And I think it's part of the reason why I think I see home run derby or be small and nimble and be a good business and patient and have options is I think that's the whole factory line thing is like the good businesses aren't worth as much as people thought they were. The great businesses are worth more. Right. And so I just think that you're not going to see it because like no one cares if you make $200 million a year.
Jason's narrative is right. I think the timing is probably wrong. So I think the number of companies that are out there that are refactoring their business plans to become good companies, that I think the public markets would understand the narrative and be willing to own, for a longer period of time. I mean, it's companies that do hundreds of millions of dollars of high margin revenue or billions of dollars of low margin revenue, right? And if you can find yourself in one of those pockets where you're still growing at a pretty good clip and you're capital efficient, like public markets like those companies, especially if they're repeatable and especially if you're locking in a lot of the revenue from one year to the next. So I think there are a lot of companies that are refactoring their business plans to be healthy. They've been doing that work for the past year and a half, once the global memo went out that money wasn't going to be free and cheap. Free and abundant. So I think there are a lot of companies that are kind of baking and it's just a matter of time. But I don't think it's going to be one a week in the back half of next year. I think it will open up in the back half of next year and maybe the year after.
I just think you're going to take the bet too, right? You're going to go in with Harry. It's 3-1. You're taking this bet too, Frank? It's 10 grand.
Sure.
It's a fun.
Right, I got a lot of exposure here, Harry. I got 80 grand of exposure here. I'm a little optimistic. Frank said I'm directionally correct. My timing's too optimistic, and that sounds quite plausible to me. That sounds quite plausible that I'm a little optimistic. The only thing I would say is, what's that?
I was going to say, you don't like the plausibility that the entire idea of a $200 million revenue growing public company is bunk in the future? You don't like that?
You might be right. I just think, here's the thing. If you look at the HubSpots and the others, you can do a 10Xer in the public markets. Like there's two ways to look at the IPO. Either I can price it cheap and let me flip it, right? Which I think is going to be important the next year, right? Is that we don't do these Bill Gurley perfect pricings for a while. And then, hey, is this as good as HubSpot when at IPO? Do I have a shot at 10X? going to your point, actually, Sam, I think that's a great bet if it has a chance to be. Worst case, I lose a little bit of money and can write off some long-term capital gains. Best case, there isn't a ceiling to some of these folks, like the HubSpots, the Datadogs. I'll take. So I'm optimistic. I also think, look, it's nothing like today. The only thing I'll say is 08 and 09 were like, I know VCs think differently. I think 08, 09 as a founder was like 50 trillion times worse than today. The world was ending in 08 and 09, right? And when we came out of this in 2011 and 2012, I know it's not the same, but we bounced back so much faster than we thought. And when I look at what Atlassian is saying, like they're bouncing off the bottom and Mongo's bouncing off the bottom and other folks are seeing things improve. I don't know that we always, I know this is VCism that I'm good at, but we don't always know the slope of the curve in the early days, right? So I do think there's a chance. We're never going back to 2021, but I think there's a chance 2024 is better than it feels in our gut today. Like, I think the slope may be better than we think.
It might be better. I just think like the future seems to me to be like Constellation software style, like roll-ups, PE, you own a bunch of things and get bulk up, / it's the megadons or whatever you want to call them. Cause like, you know,
we've been saying that for decades.
But it kind of is playing out, right? And like, I think that's the thing is like, you look at, you know, my vision would be like, there used to be this idea that like companies could only get so big, right? And so like the reason you didn't buy more Apple stock at $1 trillion or at 800 billion, because no one's seen $1 trillion company, right? Now, like, be as big as you want. Like there seems to be no upper bound and the biggest guys are crushing it, right? And so to me, as long as the biggest guys keep crushing it and retail and everyone's like, I can just buy more Apple stock, right? Like maybe that's not the best example this week, but like, you know.
In 2021, we took 5 companies public from our portfolio, and that's just our portfolio. And these are very good companies, you know, somewhere in the $1 billion to $40 billion print, you know, in the public markets, you know, and we see a lot more just in our portfolio, you know, that have IPO potential. So if we're a fintech specialist and we see the potential in our own portfolio for, you know, another half dozen or dozen like IPOs that are kind of orienting themselves and getting ready when they get to sufficient scale, like there have to be many multiples of that when you go outside of fintech. If you go into SaaS, if you go into healthcare, you go into these different sectors. So I think there are a lot of very large companies that could be made. And if you go back to the math of, you know, 2 to 4% of startups like have the potential to IPO, you can run the math based on the number of startups. Like there are a lot of them that are baking. We just don't know which ones they are yet.
It's certainly a safe bet.
Yeah. You know, the beauty is in venture, we can always just raise another fund. You know, the great thing is everyone gets to write off their 2021 fund, right? The LPs aren't even holding it against VCs anymore. So we VCs have this special gift. You know, everyone's allowed one bad fund, aren't they?
So can I just throw one more grenade out there? That's like, I completely agree with everything that we've said today in terms of the factory output and the kind of packaging, but show me the incentive and I'll show you the outcome. The LP world is not changing. We can say what we want, but Andreessen will still get their funds. So will Lightspeed. The returns will go down.
But they're not, Harry. I think that's wrong. Like they're cutting fund sizes left and right, and they're combining funds to bulk them up. I actually think that you're seeing very real repercussions, right, as people realign here. They are not getting their funds.
Well, really? Are you? No, wrong. You're seeing Inside at 20, and you're seeing TCV at 6, 7.
This is where you gotta. This is where unfortunately I have to talk to the other Lessin because my wife has much more detail. But I promise you, if you read the information, there have been many articles published recently about people dramatically cutting / underfunding funds, combining funds to bulk them up because they can't raise the vertical vehicles, etc. There is absolutely an LP pullback, right, on this, like, and it's very real and material. Now, will Andreessen raise any fund? Of course. But like, you know, the scale is definitely dropping.
I think Frank has the most data, but I looked at this before in 2019. I could have updated it because it'd be better. But in 2019, the average SaaS company that went public absorbed just shy of 400 million in capital, 390 million in capital before they went public. Now, there haven't been any IPOs for a while, and there's a few down rounds going on. But I have to assume when the engine revives, we will absorb 400 million again per IPO. And that should reflate all these mega funds. Like no matter what else is happening today with venture being negative for LPs last year and valuations being down, there's some raw math. I think these bigger funds are designed to absorb that 400 million, right? How can I put 200 million of the 400 million going into Datadog or whatever? Like that's their goal, right? And it's just 400 million. We don't have room for 4 billion into these. I mean, that's what probably happened in 2021, right? We deployed as if there was 4 billion because of the unicorn bloat, but it's still 400 million per company.
LPs are waking up. I mean, we just completed a fundraise and talked to actually, I don't know, probably 150 LPs. A lot of them are the same LPs that end up funding a lot of the funds. And they definitely are waking up. Like if you are a mid-tier firm with good but not great results, like they are consolidating. They are making very strategic choices about which funds they're putting money into and which ones they're not going to renew. You can talk to the LPs. They have, very tough conversations about which emerging managers that they did fund that they're no longer going to fund when they come back to market. So I think this plays out over a number of years. It doesn't happen instantaneously, which is why you might not be seeing it or feeling it. Also, a lot of the funds aren't coming back to market because they know that they would be raising off of a track record, which is depressed, right? Because everyone is taking markdowns right now. So they're avoiding going back to market. If they did go back to market, a lot of them wouldn't be received very well. So there is a period of time right now where the LPs are awake and they are rationalizing where they're putting their money. And the question is, like, if Jason is right with the IPOs, then money will flow back into the LP ecosystem once the IPO window kind of opens up, and that might reverse course. But I think for a number of years, like if you are a middling fund, or an emerging manager, you are going to have problems raising capital.
Right, we're going to do a quick fire round, chaps. Otherwise, I'm going to keep you all day. So I'm going to say a short statement to each of you. I'm going to direct it, and then we're going to rock and roll. We'll do one each. Let's go with Frank. What's the most important trend in the venture world that not many people are paying attention to?
I think we talked about it. I think companies are trying to figure out how to make money at low levels of scale. And I think the capital efficiency is coming back into kind of the decision making, within the venture world.
Do you think not many people are paying attention to that?
I think that at the earliest stage, they still think narrative is carrying the day. And I think narrative is going to stop at the seed when it used to flow through to the Series A and even into the Series B. So I think the trend is you can raise on narrative at seed and then its results starting in Series A.
Sam, what do you believe that most around you disbelieve?
Like everything? What do I believe in most? In venture capital?
Could be in life, Sam. I love your brain, if I'm honest. You could just go for anything.
I mean, that's a great question, but it's one I'm not sure I'm going to have a great off-the-cuff answer to. I'll tell you, the first thing that comes to mind is just like, I think kind of, again, to play back what we were talking about today, because it's top of mind, obviously, is like, I am very excited to fund a bunch of companies at 5 and under in weird things that are coming to me because no one else will give them money, that are going to be highly profitable on the way up and create option value down the line, right? So it's kind of a riff on what Frank is saying, but a different way, but like an earlier thing, which is like, that's my jam. Like, I don't want to ever be relying on a Series A firm again.
Jason, final one. What would you most like to change about the world of venture moving forwards? You have your magic wand. You can change anything.
Well, I wish my magic wand worked. I would like to, going back to Frank's point, I would like to have more concentration rounds. I would like to be able to magically buy at least 10% of any seed company I meet that I want to invest in. That would be a gift. That's my biggest stumbling block to investing, is like, I have to wait on too many deals where I can't get double-digit ownerships, and I just don't believe I can make any money without it.
Guys, listen, I've loved doing this. Thank you so much for universally betting against Jason with me on this. I super appreciate the support.
I feel like I'm going to lose 70 grand, but it's okay.
But guys, honestly, this has been fantastic. So thank you so much.